Welcome back to Morning Trade Live. All the excitement yesterday, of course, about Fed Chair Jay Powell and his turn towards doves. All right, I want to bring in Kevin Hanks, who's joining us, co-host of Fast Market and TD Ameritrade Newsroom. And we've got Michael Ashton, the inflation guy and the managing principal at Enduring Investments, back with us. Okay, Michael, from your perspective, tell me what you learned yesterday as it applies to the outlook on inflation and things that matter to the Fed.
Well, I think what's interesting, there was a bunch that was uninteresting that came out of the Powell speech, but I think that what was really interesting was the market reaction seemed like an overreaction by the natural language algos that heard that Powell now thinks that the interest rates are just below the neutral rate of interest.
Yep.
When that's not in fact what he said. I think that
we're somewhat close, right?
Well, so what he said a month ago, what he has been saying is that interest rates were well below the neutral rate of interest.
Yeah.
What he said yesterday was he said interest rates are a little below the broad range of estimates of the neutral rate. So if you're in one case you're in one case you're talking about a point estimate, and in another case you're talking about being at the below the lower edge of.
You're talking dot plot, basically.
End of a big range, yeah. So yeah, I mean I don't think that's qualitatively or quantitatively very much different from what he had been saying in the past. If this was Greenspan or Bernanke, I'd say, that nuance was something that he meant to put there, and he meant to say something, good for the market. I don't think Powell cares about the market, and I don't think that he meant to say that, oh, no, I've totally changed my mind in a month. I think actually we're pretty close to done. Well, I don't think that's what he was saying.
I think it's a really interesting point, Kevin, because basically, to put that in context, we've got the dot plot, right? Because a bunch of different people at the Fed think a bunch of different things. So if you were to take that middle point, but that's not really what Michael's saying is Powell's communicating, Kevin. Powell's saying, look, towards the bottom end, yeah, we're kind of along that line. There's more of a spectrum than, say, a specific point. So, Kevin, as a trader, when you see the market react the way it did, to you, does that tell us that Powell demonstrably changed a tone, or is this kind of a sentiment where all of a sudden investors just maybe oversold, needed a reason to bounce?
Oliver, you wish you had $1 for every time that I've said uncertainty turning to certainty, right? That's what causes markets to move. Well, it seems like Jerome Powell went from certainty in terms of rising interest rates to now uncertainty in terms of rising interest rates, and that's what I think the market liked about that. The fact that the words data dependent.
They like that he's not convinced that he's got to just ramp it up.
Exactly, right. And I think the market liked that because now the market can look at data like we got today on income and outlays and say, okay, that's not very inflationary, right? So then the market can react purely to that and not have this cloud over them of, hey, Jerome Powell's raising rates no matter what. So it doesn't matter what the economic data tells us. I think that's what happened yesterday, and that put a trade underneath this market that gave it life. That really, if you looked hour to hour, it never backed off really.
So for you as an intraday type, go ahead, Michael, go ahead.
Well, I was just going to say, you thought you would see a much bigger reaction from interest rates, and
right.
That's right. I mean, if you're going to, and that's a very good point, going from certainty to uncertainty, certainly should change the value, but you didn't really see the big reaction in interest rates. You saw it all in equities, and that's the part that's kind of
Michael, I love that, because we talked about this yesterday. The 10-year didn't really do much, right? A little bit of buying this morning, a little bit more. We're still at 3%. Now, does that tell us? What does that tell us, Mike? Because I imagine that's got to do something right with your right up your alley, which is about inflation and the fact that maybe some of the forces behind higher yields aren't really going away yet.
Yeah, it's kind of curious. I sort of thought that when we started to see sort of some softening in these the activity indicators, the PMIs and you're starting to see initial claims maybe starting to creep up a little bit, but just at the margin. But I thought that we would at that point see that maybe 10-year rates had gone too far. We might see them rally back below 3%, and there just hasn't been a lot of it, especially it's a very good seasonal part of the year for bonds. And we really haven't seen that yet. So I do think there is, there's this underlying upward pressure. We still haven't seen the tariff effect yet, which we know is coming on prices. We're still seeing upward pressure on freight prices, freight rates, upward pressure on wages. And I think that bond traders are, maybe they're still uncertain, I guess, about whether or not, much lower rates are going to make a lot of sense.
Yeah. Kevin, the question that you and I kind of talked about this morning that I also brought to JJ about the reaction to this is it's a sentiment shift, is your point, Kevin. And I agree, because when things are not looking as certain that Powell's going to ramp it up as quickly, market then likes that. So do you need to see some degree of follow through? I know for the intraday, the reaction was clear. But longer term in the scope of what drives markets, Kev, do you need to see that strength continue to justify and basically to tell us, because we can only, basically process what the market does. If that sentiment doesn't last, and this is not a lasting force, should we be worried that maybe it was overhyped, that really this is not what the market was concerned about? They were maybe concerned about peak earnings. I don't know.
Yeah, no, I think, I've seen enough of these markets to know that Jerome Powell's comments, what was it, early October on interest rates, put some uncertainty in the market. And, higher interest rates do create some, it creates competition for yield,
of course,
right? And that would cause people to maybe roll out of stocks and into bonds. And that in itself causes uncertainty in the market. I think what Jerome Powell did yesterday was just lighten that tone from his comments. Remember, that were, in an interview, so they weren't official. But, he maybe got caught saying things a little bit more hawkish than he would like to. I think Janet Yellen was very good at balanced discussions and her talking points. Jerome Powell was kind of leaning hawkish every time he spoke, or the majority of times that he spoke. Now he's gone a little softer on some of his rhetoric.
Right. So, Michael, the core question that I'm grappling with, hopefully you can bring me and the viewers some clarity, is again about this 10-year yield. The Fed choices obviously affect that, but they're not the only thing. And what really matters to the equity market is exactly what Kevin just said, competition for yield. So did we get some information yesterday that tells us the 10-year is not going to keep moving up? I get that maybe we got the Fed funds rate is not going to move up as quickly, but what about that long-term bond?
It's actually it's a little hard to tell right now looking at inflation markets, because inflation markets are being totally polluted by the collapse in oil prices.
Yeah.
And so you've got to extract the energy prices from the indicators we see in the market, and we actually do that. And when you do that, you see that the market's estimate of core inflation hasn't really changed. It hasn't really come down very much. Usually the inflation market overreacts, and in this case, it looks like maybe it isn't. So I still think that there's this underlying concern, which I share, that we may have broken the back of this long-term virtuous cycle in interest rates and inflation to lower interest rates and lower inflation, and we may be heading back up the other way, slowly over a period of number of years.
Okay.
But last time I was on this program, we talked about that multi-generational downtrend in 10-year yields, and that we got well above the top of that channel, and we still are. So I think that there's the underlying concern about inflation, and there's the fact that we're pumping out a tremendous amount of debt, and whereas the Fed used to be buying it, now the Fed is selling it
out.
So you do have a supply and demand dynamic that comes into play as well.